Okay, we're going to talk about home loans and their rates and HELOCs, home equity line of credit, in first position. That's very important. First of all, interest rate, people get confused with that, and some people are fixated on interest rate when you really don't need to focus on that, and I'll explain why. Okay, so in Fahrenheit, we have 32 degrees Fahrenheit. That is freezing. Over here in Celsius, 0 Celsius is also freezing. Same thing, big difference in numbers. If we increase this 1 degree, now we are not freezing, but we still have a difference, but they are very, very close. So I hope that will kind of help you understand as we get going why your interest rate really is not the issue, okay? And also, most people are also focused on their monthly payment. And in the next video, we're gonna be talking about why that also is not the issue, but I want you to be putting these little things in the back of your mind to help you see what is important. Okay, I have an example here of a home loan at $200,000 is the loan balance for 30 years fixed at a 6% interest rate. The total payment is $1,200 per month. That's including your principal and your interest. Okay, so this is a one-dimensional loan. That means that it's an inactive account. That means once you have paid the bank, you don't get any money back. You can't get any money out if you have emergencies. And you know that they like that. Once you pay off this loan after 30 years, you in total interest, you have bought yourself a home and you've bought the bank a home because of compound interest. Okay, so what they do is they front load the loan. You're paying the interest at the beginning of the loan, and it takes about 17 years before your break-even point, and where your payment starts to pay off that principal. Now, principal means that you're paying down what you owe on the loan, not the bank's interest. So it takes about 17 years for that. Now, the problem that we've had here in America is most people either move before 5 years, or around the 4 or 5 years mark, they refinance. Now, refinancing is like an addiction. It's like crack for mortgage lenders, and I have seen that, and so that's why I'm trying to teach you how to pay off your home with this. But first, I need you to understand. Okay, down here with these numbers. So we're going to talk about this. Around that 4-year mark, okay? That's kind of when people start to change their mortgage. And so what happens is you've got, at 4 years, 1,200 times 48, that's 4 years, that's how much interest that you have paid, okay? And we'll break it down here. I'm sorry, I shouldn't have said that. So that's totally what you've paid. It's that $57,600. So the interest is the 950 times 48, which is 48 months. That's 45,600, and your principal that you've paid is 12,000. You add those together and you get 57,600. Okay, so people think, oh, I'm going to refinance to a lower rate, but you're not only paying fees, you may be paying, getting a lower rate and a lower payment, but you're starting all over on your loan with more interest. Now, nowadays on the closing document, it's called a CD. At the very last page, it's going to have this TIP. Most people do not know this, so it is disclosed. They told you, but it is not explained to you what it means. And it has a big percentage mark. 70 to 80% is the usual number. And of course, it's an actual percentage, so maybe it's 73%, but that is your actual interest rate over the course of the 30-year loan if you were to pay that all the way for 30 years. So you can see why this is like crack, because people will just redo and redo and redo their loan. Even if you don't redo your loan and you pay that thing off over time, the amortization for 30 years, you are still paying way too much interest. You're basically paying this number. So which one is lower? 32, 70? And look at our example over here. So we have 21%. What's lower? 21 or 70. Okay, so here we are at a HELOC first position. HELOC, okay, home equity line of credit. There's many different kinds of HELOCs. So it's important that you get the correct one. Our example is a $15,000 limit. Now, a HELOC is kind of like a credit card in the fact that it is on simple interest. It is revolving or two-dimensional, meaning it's an active account. In our example, we have a 600-month minimum payment at 21% interest. And the bank doesn't know how long it's going to take for you to pay this off. So they've given you a minimum payment. But let's say, you pay $650 1 month, okay? Well, now you've paid down, so it's now down to zero, what your balance is. So that means instead of having a $14,400 now credit limit, now you're back up to the $15,000 credit limit. And you're not, if you pay that whole, and let's say that you only took out $600 and you pay it all off at once, or $650, you paid it all off, then you're not charged because you're only charged on what you take out. Now let's say you do take out the whole $15,000 and that's your payment for the month, then you would be charged for that amount of interest. So the more payments you put into it, like a credit card, it's gonna pay it off faster. So we're gonna, in the next video, talk about how you can accelerate, it's called velocity banking, and how you can get your mortgage paid off in 7 years or less using this method to not pay the bank so much interest, save yourself some money, and then be able to do other things with that money because you now own the bank for yourself. You become the bank for your own money, and your money is working hard for you.